Today we're starting a new series called 3v1, where every week we take a look at 3 stocks that I think the market has been undervaluing and one more that might be a little problematic, and if it's in your portfolio, you might want to look at unloading some if you haven't already. First up is AT&T. For those who don't know, AT&T is the world's largest telecommunications provider. They specialize in landline, internet, DirecTV, and cell services, and the price at the moment has declined to almost 30-year lows. The reason for this is threefold. First of all, revenue growth over the last 10 years or so has been mostly flat. The reason for this is that as more people have adopted cell service and satellite internet, fewer people are opting for the landline and cable TV businesses. The second reason is that AT&T has a very substantial burden of debt. The reason for this is their recent very substantial expansion of their 5G capacity and their laying down of new fiber internet to new parts of the United States. This debt burden represents an outsized risk for AT&T at a time of rising interest rates, and the market has priced this in accordingly. And third, WSJ has recently reported that AT&T, Verizon, and T-Mobile collectively have about 20,000 kilometers of lead-sheathed cables that the market was very worried would present a substantial environmental risk and threaten all the major telecom providers with massive lawsuits. AT&T have concluded that the environmental risk presented by these cables is fairly contained and does not present a risk to the general public at this time. AT&T has come up with a plan to contain the total damages from this report and remove those cables over the coming months and years. Additionally, there is an ongoing threat to all carriers that Amazon may enter the business wholesale. So far, no provider has actually agreed to let Amazon on board, but if one were to break ranks, that would introduce an unwelcome element of competition in an industry where the prospects for continued expansion are relatively small as it is. According to the analysts at Morningstar, AT&T is currently about 30 to 40% undervalued. Currently it sits at around $14 a share. Morningstar says it should be up around 22 or so. Additionally, AT&T has a very substantial economic moat, allowing it to maintain its competitive edge, helping it to keep out smaller companies from the space. Now, on the flip side of that coin, regulators see that because AT&T is so big, they have responsibilities to the public in order to avoid being broken up a second time. Their legacy landline business currently serves millions of Americans, and this is a legal contractual responsibility that represents a very, very large fixed cost for AT&T that they need to maintain at reasonable prices even when the rest of their business environment begins to look less favorable. On the upside though, despite these risks, the company is looking fairly stable, and they're paying more than a 7% dividend, which offsets some of those risks fairly nicely. This is definitely one that I've chosen to add to my portfolio, and it may very well be worth your time to have a look. The next company I want to have a look at today is the aforementioned Verizon. They're one of AT&T's main rivals in the wireless communications space, and they too have suffered from the same problems of limited outside growth potential, high capital costs from 5G network deployments, and Amazon threatening to enter the wireless business, which would make the hardline internet investments that both Verizon and AT&T have been making over the recent years significantly less profitable. But also like AT&T, the lead-sheathed cables unearthed by the Wall Street Journal do not present a massive environmental or legal risk at this particular time, despite the fact a very significant amount of risk has been priced in over the last 52 weeks. Overall, similar to AT&T, Verizon is a very large, relatively stable company with a sustainable customer base and reasonable prospects to take advantage of emerging technologies in the future as it relates to 5G deployment. And the third company I want to look at today is Citigroup. This is a massive multinational US bank that is squarely in the middle of the too big to fail category. Basically, that just means that the US government considers this an institutional business that, were they to allow it to fail, would present a massive outsized risk to the rest of the economy. They were one of the main companies that were bailed out in the 2008 recession, and should another major market crisis arise, they would be in a position to receive another such bailout. They're currently trading at $47 a share, which Morningstar considers to be a very significant discount. They're coming out with a 4.5% dividend yield, and that's even after weaker fee collection from its main retail banking business unit. The main source of their growth for this quarter has been their Treasury and Trade Services, which is basically the division of the company that provides massive loans to governments and international trade corporations to float their major business activities. So basically you can think of it as a too big to fail corporation that's being supported by other corporations which are also too big to fail. One stock that I am rather concerned about at this particular moment is Disney. Just in case anyone doesn't know who Disney is, they're the people who run Disney World, own Mickey Mouse, and are currently one of the biggest streaming services in the game, giving Netflix a run for their money. Over the course of the last 52 weeks, the company recently reinstated retired CEO Bob Iger to turn the ship around after very significant losses in the streaming department. They've been shedding streaming subscribers for the last 2 quarters, and recent major theatrical releases have been a pretty significant bust. That said, they are relatively well positioned at this particular moment to deal with the WGA writers' strike and the SGA actors' strike, but those two unions are in a very strong position to spread ill will between Disney and its streaming subscribers if they can't come to terms in relatively short order.
It's an interesting strike for a variety of reasons. Pay, obviously, they want more. Artificial intelligence, but let's talk about residuals.
Additionally, the dividend is not very high, only coming in at about 1 to 2%. And so any risks that are present at this time from strikes and recent losses are not being very well offset by quarterly cash flow. So you may want to think twice about adding this one to your portfolio, despite the fact that it is trading at a pretty significant discount related to its 52-week high. And that's it for this week, everyone. Thank you so much for watching. If you did enjoy what you saw here today, please feel free to click the like button and the subscribe button so you never miss another weekly edition of 3v1. Let me know what your thoughts are in the comments, and I'll make sure to include all the research for this video in the description so you can check it out for yourself and make sure you can make your own decisions before any changes to your portfolio. Here on YDFM, we have a lot of really exciting content planned for the next couple of weeks, so also make sure to click the bell button so you never miss another upload. I'm James Davies, and I look forward to seeing you in the next one. Bye for now.